It has been a choppy ride for the markets over the past few weeks. Despite several attempts, the indices have failed to cling to the gains and succumb to global and domestic cues. Analysts expect the markets to remain choppy in 2022, but there would be ample stock-specific opportunities all through the year, they suggest. However, analysts caution that timing the markets will not be a wise strategy at the current levels given the slew of domestic and global developments over the next few weeks. For instance, geopolitical developments related to the Russia-Ukraine war and its implications in commodity markets, especially oil and gas, will keep the global markets volatile. At home, the RBI's plans to hike rates may not have been fully discounted yet by the markets.
Clearly, the response is not yet adequate to the inflation increase, and therefore another 50 basis point increase in the June credit policy is very likely. So, if you look at the bond markets, the 7.2% 10-year GSEC has moved to about 7.4 to 7.5, and next month it could be another 50 basis point higher. So right now it is factoring in up to what happened till the May meeting, but it is obviously not yet factoring in the June increase. Well, there is no harm in doing a weighted average buy on every decline, especially the blue chips, which have been resilient over time, over market and economy cycles. So, therefore, I don't see any issue because our economy in general is doing well, and there will be some amount of setback for 6 to 9 months. But as the market falls and the valuations become attractive, there is no problem in buying the blue chips. I have earlier put out our target at 14,660 for the Nifty and 17 times on calendar 22 earnings.
Sonal Verma of Nomura meanwhile says she expects a 50 basis points hike in June and 35 basis points in August and a terminal rate of 6.25% by April 23. However, rising fiscal risks will likely complicate the RBI's liquidity withdrawal strategy. Thus far in 2022, the S&P BSE Sensex and the Nifty 50 have lost around 7% each. The correction in the mid and small caps has been even sharper, with both the indices slipping 10% and 11% respectively on the BSE during this period. In the past week, however, there has been some pullback as the S&P, BSE Sensex and the Nifty 50 moved up nearly 2.5% each amid volatility. Analysts believe the recent pullback may still have some steam left. According to ICICI Securities, the current recovery for the Nifty may extend towards 17,000 levels. However, 15,600 will remain a very crucial level to watch out for. As regards inflation, analysts believe the government's measures to cut excise duty on petrol and diesel as regards inflation and measures to bring down the cost of cement and steel will be beneficial. Yet, inflation could remain substantially above the RBI's target range of 2 to 6%. On the contrary, any correction in oil and commodity prices might allay the inflation fears to some extent and present the trigger for an up move in the markets. Sunil Singhania of Abacus Asset Merger on his part believes that inflation has peaked. If our view on oil, commodity and inflation does come true, then there might be a surprise of interest rising less than expected, says Singhania. Any such possibility can be a key catalyst for a risk-on and positive for equity markets, he says. With fundamentals continuing to be strong for India and now valuations also in line with 10-year averages, Singhania believes the risk-reward for investors is only getting better. The asset manager continues to remain constructive on the markets. On Friday, the markets are likely to remain choppy in a range as they track domestic and global cues. Stock-specific action, however, will continue.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.